All right, on this episode, I've got Danny Miller from Genrevv, who I think is probably one of the top authorities in the space when it comes to running paid ads for your syndication in order to raise capital. Danny's got a tremendous amount of insight because he's got such a pulse on the market and what's happening, what's working for syndicators, what's not working. This is an episode I think is going to be jam packed with tips as well as insights and strategy that can help you if you're thinking it might be time to tap into paid media to help raise more capital. So check it out. All right, guys, welcome back. Today I've got a very special guest to talk about the investor relations side of things when it comes to running paid ads, as well as the whole process, really, A to Z. Danny Miller from Genrevv. Thanks for being on, man.
Thanks for having me. Really appreciate it.
Dude, we've actually collaborated on quite a few mutual clients, and I feel like we kind of hit it off early on because we spoke the same language. I, way back in the day, had a marketing company, so I understood paid ads and the objectives and kind of this idea of attribution and like the big picture of the sales funnel. And I felt like the first conversation we had was like, well, this guy gets it. Okay, perfect. Like, this is who I've been looking for.
Correct.
Tell me how you got into all this. Like, how did this start? How did you become known as, because I would consider you the guy when it comes to running paid ads for real estate investors. How'd you get into all this?
Yeah, sure. So I think the reason that we hit it off is because like I'm a data guy originally. So
Mm.
I guess backstory, first job ever, shoveling shit at a horse barn. So that's kind of like the power of hard work, I think, from the very beginning. And it was,
That's
I'd say, probably my
the title of your book. From
that's
shoveling
right.
shit to
Yeah, it's still my favorite job to this day. But anyways, like in college, I studied data analytics. So I was like kind of a SQL, supply chain coding guy, took the very traditional path. I went and worked at a big four accounting firm in their consulting practice, PricewaterhouseCoopers. And so I ended up quitting after like 2 months and 22 days. I was very bored. There's a whole backstory to that. And started Genrevv, which originally was this generalist marketing agency that over the course of time and a lot of serendipitous connections, somebody at one point had asked me, like, hey, can you run the same customer acquisition model that you're running for my info product, my mastermind education program for raising capital? This was like in 2020. So I have no idea, but I would love to try, and so we ended up trying and we ended up being pretty successful, and the rest is history from there. So, today serving over 40 clients in space, helping real estate private equity guys and traditional private equity guys raise money online.
Yeah, I feel like I can't go into a mastermind group or any kind of like investor setting without bumping into somebody that uses you.
Hopefully all saying good things. But yeah, we've been really fortunate.
Dude, that's awesome. Okay. What I'd like to do is kind of go back and forth between like some big picture stuff as well as, maybe some tactics, some details. But tell me what you're seeing kind of high level just in the market today. Like what's happening when it comes to the environment around raising capital in general and specifically when it comes to paid media and what that looks like. Yeah, give me kind of your quick take on where the market's at when it comes to raising dollars.
Sure. Yeah, so I think my macro take is going to be very similar to the paid take, because I think that what you see on paid advertising is kind of extrapolated across any channel through which you're acquiring investors. So if we think about it big picture, I think it's no secret to anybody that like it's harder to raise capital in 25 than it was in 24, and probably harder than it was in 23. You can point to market forces as the challenges there. I think like big picture, the unfortunate reality is that in the private placements, kind of 506C Reg D world, is you've got lots of deals that have gone, pause distributions. And in many cases, for good reason, right? To protect the assets and do right by the investors. But I think that part of what the industry has seen is an erosion of trust. And people are like, well, I'm not investing in the next one if this one's not paying me, right? And oftentimes, whether you're acquiring new investors from paid channels, referral, or otherwise, the most likely folks to convert are the ones who have already read through somebody else's 100-page PPM. They've already kind of overcome that hurdle of entering the private markets. So to the extent that those people are not really achieving the results that they were expecting, I think everybody else is kind of paying the price in the way of lower conversion rates on net new investors, and then really smaller reinvestment rates from those existing investors who are maybe not as satisfied as they were in previous years. So how does that kind of manifest in, really all acquisitions channel, paid, organic and referral and otherwise, is you're tending to see higher acquisition costs, generally speaking. There are definitely ways that you can stand out and overcome those high acquisition costs. We've got plenty of customers that are still enjoying costs of capital that are equivalent to the glory days of 22 and 23. And I'm happy to talk about what those folks are doing. So it's by no means a total doomsday scenario. We still think there's tons of opportunity to be successful. Raising money again from any channel, whether it's paid or you're doing in-person events or newsletters or whatnot. I think there's lots of opportunity, but the groups that are winning are dialed in a different way. It's no longer a set it and forget it capital raising environment, which I think is frankly kind of how it was a few years ago.
Sure. For the groups that are winning, I'm sure there's obviously a level, and you're going to share this with us, of what they're doing tactically from a copy, frequency, creative standpoint in running ads. But what else are they doing when it comes to reputation? Or, you mentioned if distributions are paused, someone's less likely to invest in the next one. But the irony is that that's actually what you want them to do, because their fiduciary responsibility is to protect your investment. And so it's kind of what you hired them for in the first place, was to make decisions like that. And so it's almost a little bit of a apples and oranges conversation when you want them to invest in the next deal, because it's completely different environment. And this actually could be a way better deal in today's market. Are you seeing where investors have less of an appetite because of that, because of the distrust, where their average dollar amount is starting to go down and they're maybe diversifying across multiple syndications a little bit more? And then those guys who are bringing in those dollars, what are they doing, I guess, to give confidence of, hey, we didn't have a problem in our underwriting or acquisition model. There was just some market economics that maybe were unforeseen, that a lot of people in the industry are paying the price for. And so we don't have a problem with our underwriting or our acquisitions. And so this next deal that we're offering is actually even better than this one was, although the investor doesn't see it that way. So what are the guys who are winning, what are they doing to kind of convey that? And then, yeah, just tiny like side note question is, are you seeing the average investment amount going down because of that?
So I guess like I'll answer in order. First thing, I would say like success in capital raising is a function of trust. So when there is a lack of trust, success is diluted. So I think that what are the best groups doing? I think the easier way to look at it is like, what are the underperforming groups not doing, right? And if you got underperforming deals and you're not communicating frequently with investors, like that's probably not going to result in a really high reinvestment rate, among those folks. I think it's really important that the GPs stay in front of people. If they're not meeting investors in person, shaking hands, right? Like I think that some of these trust levers are really important. And are you treating investors like you would somebody that you really care about? Or are they a check in InvestNext or Appfolio and kind of a number on the screen? And I think that the groups that are having disproportionately better outcomes are not looking at these people as numbers in their investor management system, but instead as a real people, and they're building real relationships. I think at the end of the day, the industry wants, just kind of from what I hear across the client base, is everybody wants to automate their way out of capital raising, right? It's like, what can we do with AI? How can we automate it? We're using it. We're helping people, deploy those tools inside of their processes. But I think at the end of the day, like this is a people business. You're asking a stranger on the internet, in our case, right, through the paid channel, to write you a check for 100 grand or 250 grand. Um, at some point, you're going to have to show up and say hello. I think just kind of like the coming back to how can I build trust with people is really number one. So, trust is going to be built again through transparency, frequency of communication, authenticity. I think those are like some of the buzzwords, right? Remind me the second question that you asked, Ian.
Are you seeing the dollar amount, the average investment amount going down, where guys are diversifying maybe across multiple syndications, writing smaller checks?
Actually not seeing that. So we're seeing sales cycles elongate, which I would say is makes a lot of sense, right? It's like My first deal wasn't as good. I'm going to spend a longer diligence period on future deals. We're actually seeing check sizes go up. So check sizes up, sales
Interesting.
cycles longer is generally what we're seeing across the board right now. And I think that like, and again, just kind of like tying this to the market, right? It's like when times are good, it's like, oh, okay, I've got 250 grand to deploy, 50 here, 50 there, 50 here, 50 there. Everybody looks good, right? I think today now there's a higher level of scrutiny. I think there's more intentional diligence. I think you're seeing platforms like an Invest Clearly, pop up that's creating trust and transparency where LPs can kind of share their stories. People are digging, they're looking, they're asking
Oh
questions.
yeah.
But then when they find the one that they like, they're like, ooh, I don't think that dry powder has gone down, right? Like I think that the available assets to deploy are still there. I don't think it's people are broke, people have no money. I don't think that's what we're seeing. I think it's now. It's like when people are going to make a decision, they're going to take longer, but they're gonna write a bigger check because I think people are realizing the importance of getting it right.
Yeah, and you brought up the idea of leveraging AI and automating the process, and I agree with you. There is a place for it, but I think the human interactness component still has to be human. And I think we've almost trained the industry somewhat to stay stuck in this information cycle. So I'd be curious your thoughts on this. I look at the kind of the investor journey in three kind of core phases. There's information, there's risk analysis, and then there's decision making. And a lot of the times in that process, the investor relations department just keeps circling people back to information. It's like we start to go into the conversation around risk analysis, and because we can't make the risk zero, we just circle back to information as opposed to acknowledging the fact, hey, the risk is never going to be zero. How have you evaluated deals in the past? How are you evaluating this? What's your liquidity allocation look like? What are your goals for the future? Like help them on the journey of evaluating the risk, acknowledge the elephant in the room that it's not going to be zero, and move them towards making a decision. I feel like we've almost trained a lot of LPs to just go back to the information. Hey, there's another webinar. Hey, I'm
Yep.
going to send you another deck. There's going to be
Yep.
more information. How
Yep.
do we move away from that in a human way while still providing enough information? Do you recommend like a certain cadence to that? Or how does that correlate when you're seeing that conversion cycle start to elongate? How do we not just stay stuck in like, crap, I got to come up with more information to put in front of these people?
Sure. Yeah, so I'll disclaim that like I can't pretend to be an expert in IR sales process, right? I'm kind of the marketing guy, but very routinely we see exactly what you're talking about, which is, hey, I had a great first call with this person. Like, I want to send them a deck. I want to send them a one pager. I want to send them this, and they say send me the materials, and then the lead stalls out. And I think it's exactly what you're talking about, right? It's like your three phases I think are spot on. I would call it discovery, diligence, deal close. I think we're talking the exact same language. And I think you're right. People kind of get looped back to that discovery or information phase. And I think that this is actually less of a marketing question, probably more of a sales question. So I'd be curious on your take as well. But ultimately, I think that IR teams need to understand like what are the components to decision making, right? And being blunt in that process to say like, hey, I've presented you all of the information. Do we have what else do you need to see, right? I think that these are like reasonable questions to ask people in the process, and kind of taking somebody through end to end. It's like, okay, like what are the components that are important to you? And I think that as I've listened to IR calls, I'm sure you've done the same. A lot of what you hear is the information overload. Let me tell you about the deal. Let me tell you about the deal. Let me tell you about this. Let me tell you about that. We're not hearing like the traditional consultative selling of asking these like second, third, fourth, fifth level order questions of like, you know, Ian, what's this money for, right? Like, what's the goal with the money? Oh, great. I want to, I'm looking for cash flow. Great. What do you need the cash flow for? How much cash flow are you looking to produce? Cool. What are you going to do when that cash flow is coming? How is that going to impact your life, right? Okay, great. So if I'm able to do this, this, and this, and this, and it's able to let you do this, this, and this, and that, is this something that you'd be able to move forward on in, 30 to 60 days? Yes, that sounds great. Okay, cool. So I'm going to present you with all the information. And once I've sent you all that information, do you think that you're going to be at a spot where you can make a yes, no decision? Yes, I think I'm going to be at that spot. Because I think that's like really where a lot of IR, kind of investment pipelines get clunky is they've got a lot of these people floating in the wind, and I think that there's really a lot of power in getting to know quickly. I think it feels great for the reps, and then probably for the CRO equivalent to like look at pipeline value
Mhm.
and see, oh, we've got 23 people in follow up, we've got 17 people in follow up number 2 or hot lead here, right? It's like, how quickly can you get to know on those people and really truncate that sales cycle? So I don't know if I've answered the question directly. I think again would kind of turn it back to you as the sales expert in the space, but I think it's less about marketing here and more about sales cadence.
Yeah. Well, this kind of leads me into a perfect question for you where it ties in perfectly with your data background is what kind of data points do you see or do you recommend tracking that tell you whether somebody is more likely than not to give you money within a certain time frame? I know
Love it.
in particular we collaborated with one client where we used the phrase yes, yes, yes. And the idea was, do they know the GP? Like, are they familiar with the person, kind of the figurehead? Are they familiar with the brand, like the company? And then have they ever invested in a syndication before? Because if somebody says yes to those, we're at a really good jumping off spot. And we can actually prove it with the data to say, hey, if we ask somebody this on the lead form, and then on the follow up, we see that they wire their funds within 7 days. Well, great. How do I find more of those people versus a data point like, yeah, you know who we are, you know the face of the company, but you've never invested in a syndication before. Okay, well, now I know that I probably need to send you a different email follow up campaign that's based around educating you on syndications, but also probably elongates the conversion cycle because you're going through a process of understanding the expectations and the commitment and lack of liquidity and what's going to happen here. And so now I know just based on that data point, this person's not giving me money in the next 7 days, but they may in the next 45. And at some point, there's probably those people, like you're saying, in terms of getting to know, where we can tell from the data, hey, this person, we probably don't even have a shot for 6 months. And so what are some of the data points that you're seeing that help with some of that predictability as you're siphoning through a lot of potential leads?
I love the question. So you've got, I would say, 3 layers of data that you should be looking at, and then inside of those layers, you've got data that you're requesting, and then you've got data that you're extracting without the lead knowing, if that makes sense. So I'll kind of start from the top going down. So I think you were alluding to this, right out of the gate, right? You can ask the lead whatever questions you want on the way in. Yes, more questions equals more friction equals higher cost per acquisition. That is something to be careful of, but take that out of the equation for now. Have you invested in a real estate syndication before? Generally speaking, tends to be indicative of higher likelihood to convert. I think that's an important one. As a side note, one of the questions that we ask on all the lead forms is liquidity, which historically I had always thought was kind of like a throwaway question. Recent data showing us that top bracket, the people who select the top bracket on the liquidity question have check sizes that are like 57 to 60% larger. So just as a note, that's kind of unrelated here, but I think that that's
Yeah.
valuable.
Well, let's pause on that for a second because there's a group that I was working with lately where we actually honed in on this. Not so much, I guess we use that as the jumping off point for the conversation in the actual call. And the way we articulate it was there's really 3 numbers that we got to talk about. There's a liquidity number, there's a percentage or a dollar amount of how much of that you're actually willing to invest. And then there's a third number, which is how much are you willing to invest with me, right? Either as a first time investor or just from a diversification standpoint. And so, hey, let's have a real conversation and talk about what's on the table. So you may be a million liquid, but if you're not willing to invest more than, in typical ranges, we see no more than 70% of your liquid capital, depending on economic environments. Well, now I know, okay, there's really only 700 grand on the table. Now, of that 700 grand, how much are you willing to consider investing with us as a first time investor? What we see is most investors won't allocate more than 25%. It's like, okay, so now I know we're really only having a conversation around 175 grand or so. Like, would you agree, Mr. Investor? Is that what we're really talking about? Is a $175,000 investment? Yeah. A little more, a little less. Like, and just kind of calling out the elephant in the room, but using that liquidity benchmark as a jumping off point to have a more normal conversation around what is it you're trying to accomplish. And to your point, I think having that more end goal conversation to say, hey, what is this for? What are you using it for? Well, I want cash flow. Well, how much cash flow? Well, I want this much. Well, the reality is if you want this much, you probably need to put in like 300 grand. Oh, well, I didn't realize that. So if I wrote you a check for 300 grand, I'd actually be closer to hitting those numbers. Well, based on our projections, yeah. It's like, oh, okay. And like, you'd be surprised how many guys will all of a sudden write you a $300,000 check instead of a 175 one. Or how many you turn off because your IR rep thinks they're talking about $1 million. And that's not the case.
Totally. Yeah. So the other data point kind of in that like top of funnel layer that you're not going to extract from the customer, but you're going to be like, secretly enriching into the process. So there's a company called Windfall. I don't know if you're familiar with it. Windfall is a third party data enrichment company for like wealth data. So I first came across them like 2.5, 3 years ago. They were plugged into one of our other clients. Admittedly, at the time, I was like not super understanding of the value, but about a year ago, I kind of set down this path to like open a partnership with them because I was realizing, kind of exactly to your point here. It's like, well, wait a second, like this is kind of like, particularly with paid media, there's a little bit of like a needle in the haystack component, right? If you're converting 1% of accredited leads, it's like, and then you've got incremental cost of appointment setters and closers. It's like, how can we zero the efforts more granularly in on the highest propensity to convert folks? So with the Windfall data, the main thing that they're enriching is net worth, which are verified and validated and pieced together from all of these different data sources. And what we've seen in multiple like retroactive analyses of databases, where because you plug in Windfall and it enriches all of your retro data. So it's enriching the data at a time when your sales reps didn't know the data. They didn't know the net worth stuff that was being enriched, so it couldn't have possibly influenced the sales process. And we've seen that these leads that match back to Windfall's database are converting at a 3 to 8x higher rate than leads that do not match back to Windfall's database. So like that to me is something that we've gotten a bunch of our clients on. We make virtually no money on it. But again, I mean, like as an agency guy, for me, the incentive is people getting good results and sticking around and telling their friends about it. So, we've had a lot of luck with it. I think that's like a really important one that, people should look at. Is because again, like you can go back into your own database, enrich it with Windfall data, and then there's a lot of interesting stuff you can do. I know I'm going a little bit off tangent, but I think
No,
again,
this is fantastic.
yeah, so like bigger picture, right? So I guess like kind of like the first hook for why somebody would do it is kind of like that needle in the haystack thing, right? It's like if I know that a lead that comes in that matches back to Windfall will convert at a 3 to 8 times higher rate, perhaps I will deploy more resources against that lead than other leads, right? Maybe I'll deploy programmatic mail against that lead and I'll send them a box of cookies in the mail with a handwritten letter and stand out when nobody else is doing it. Maybe instead of having my Filipino setter call that lead, I'm going to have the GP send a video message from his iPhone. Like these are the types of things, right? But
Yeah.
going down one step further, and this isn't meant to be a sales pitch for Windfall, I'm just kind of jazzed up on it of late because we got a lot of folks that are jazzed up on it, is this we call like a wallet share report. So you plug this into your database, and what you do is you build this report where on the x-axis you've got net worth bands, right? Call it 1 million to 50 million as an example. Y-axis is count of contacts, so people who have invested. And then you're breaking down the individual bars on the bar chart by the amount that they invested. And what you're looking for is the people with the $50 million net worth, $25 million net worth, the $17 million net worth that only wrote you a check for 50 grand. So the question is like, at the end of the day, everyone wants to know, how can I raise more money? And a lot of times, like the questions that I get is like, Danny, how can I raise more money without spending more money on ads? Right? Which is very common. And my whole point is like, okay, well, if you've got 32 guys in your database that have written you a check for 50 grand or 100 grand, but they've got net worth over 10 million or 15 million bucks, what can you do to build a better relationship with those guys? Are you in their city? Are you flying out to them? Are you flying them into you? Are you meeting them for dinner? Playing around a golf, like again, kind of coming back to that, relationship narrative. of like, this stuff matters, right? Like people like doing business with people that they know, like, and trust. So we're always recommending, hey, like you see some of these folks with higher net worth in the database, like go build a deeper relationship and go capture more wallet share. So you can leverage that same exact data in other ways, right? Where it's, okay, I know the net worth. So who are the people that have committed or they were down funnel and they fell out of the process? Why did they fall out of the process? Can we have a GP touch come on top of that to try to re-engage? Who are the people that we never connected with that have the higher net worth? They demonstrated interest at one point or another. Rather than going and spending, 30, 40, $50 on a new accredited lead, do we go use something like programmatic mail to try to re-engage that person for an additional $5 versus, a $30, $40, lottery ticket, right? So I think, again, huge tangent on that, but again, I think it
But
is kind of
super
directly answering.
relevant.
Yeah.
Yeah, super relevant. So when people ask me, how do I raise more money without spending more? I always look at two key metrics, show up rate and average check size. To me, those feel like the two big levers to pull. But I love what you're hitting on here is the more like detailed approach of how do we actually get there. And it was funny enough, it was my next question is like, how do you recommend like filtering the data against quality versus quantity? Because I think what happens a lot of time is groups tackle leads based on which ones were most recent, and they don't look at their CRM based on what leads are most valuable quality, right? And so this is a perfect segue into that of going, how do we actually start to evaluate what our most valuable leads are versus just our most recent leads that are coming in the door?
Yeah, good question. And this kind of continues to dovetail on where I was going to continue going on the previous
Yeah.
question, which is like, you'd ask like, what are the data points that are like really demonstrating higher propensity to move forward? The mid funnel data points that I think are really important are number of website page views and number of webinar registrations. We see both of those two data points directly correlated to likelihood to invest. So to go to your kind of to your next question here of like, how do you start to cut the data? I do think that there's value in recency, like big picture. Like I agree with you on show up rate. I would probably go one level higher in the funnel on like lead to meeting rate, right? So like speed to lead, meaning attacking most recent leads, tends to correlate to higher lead to meeting
Turns into
rate,
your show up rate. Yeah,
turns into
exactly.
your show up rate, right?
Yeah,
So I think that'll
if
kind
we
of
can hit people up within 5 minutes of them submitting the lead, we're going to have a higher show up rate.
correct, spot on. So like, I think that, but I agree with you. I don't think that it ends there. So I think that what you're looking for, beyond just these like opt-in signals. So you've got like everyone's opted in, right? So everyone opts in. So then you've got kind of like two decision points. You can kind of cut the data based on like properties about these people, or you can cut the data based on engagement. And in HubSpot, they've got like this lead scoring tool, so you can kind of do it both ways. They've got the combined score. You can split it out into the what's called a fit score or the engagement score. And I think that like for this audience, I think engagement score is probably more relevant, right? So it's what are the signals in your CRM that are demonstrating engagement? Well, if somebody has visited your website, and if you're on HubSpot, you can know when they visited your website. That's probably somebody that you want to jump on the phone with, right? If somebody's opening your marketing emails multiple times in a given month, it's probably somebody you want to try to jump on the phone with. So I think that kind of answers the question on like, how are we cutting the data? It's like, yes, recency is relevant to the extent that you've got capacity to dial all those leads effectively. Yeah, call all of them and call the most recent ones. And when you've got that excess capacity, cut the data, based on engagement, and then bring those highest engaged leads based on website page views, emails opened, webinars attended to the top of the list. And I would say in the absence of excess capacity, which I think is a common thing, right? Especially with newer operators, like, well, I don't have time to call all of the leads. Totally get it, right? So how are you looking at that? I would say like you've got to use some of the fit components. So you're probably not going to try to dial the non-accredited folks. Again, cost of doing business, generally speaking, on Meta. So you're going to call the accredited folks that say, yes, they've invested in a real estate syndication before, and probably the ones that are in a higher liquidity band. You put those guys at the top. And then you're probably got like a really, really, really tight like engagement match that you're looking for, which is like anybody that registers for a webinar, like you ought to call them, especially the ones that show up. I mean, I think that's like some of the lowest hanging fruit in the industry is like I don't know why not everybody's calling all their leads after a webinar to see what they thought about the show. So I think that's a big one that's missing. But yeah, hopefully that kind of helps sum up how I would
Yeah,
approach that.
that's huge. You mentioned a couple of things that sparked a thought. So I think a lot of guys approach running paid ads, and I want to come back to this as well, because what you guys do is obviously a whole lot more than just running the paid media side of things. But when it comes to running the paid ads, most guys are just looking at it like, how can I spend less? How can I get a lower lead cost? Right. When I look at the sales funnel, the way I look at it is, where is the constraint going to be? And if you have a small IR team, if you only have one or two guys, or you don't have a setter and you don't have somebody to call all these people, what I argue is I would rather have the marketing do the heavy lifting and filtering these people a little bit more, so that based on the constraint of, I only have two people to make phone calls or one person to make phone calls. And so I'm okay having a higher cost per lead because I'm talking to a higher quality lead. And the constraint is going to be, I only have this many people to call. So have the marketing do a little bit more of the heavy lifting to filter through people. And yes, my cost per lead is going to go up, but it's also going to be a higher likelihood to convert. And so kind of playing with what you've got, knowing that if the constraint is, I've only got this many people calling, well, let's not just ramp up how many leads can we generate and like throw spaghetti at the wall and hope some of this stuff sticks. Like, I just think that's a bad plan. One of the metrics, and I'm curious your thoughts on this, and maybe this is more on the sales side of things, but one of the metrics that we look at is touch points per lead. So how many times have we corresponded with a lead? And you have to get really clear on some of the definitions here of what is a quality conversation, what is considered a touch point. Us calling and leaving a voicemail is a lot different than us having a 5-minute or 30-minute conversation with somebody. Over the phone is a little bit different than having a Zoom with somebody. And so getting an idea of the frequency of touch points with somebody within a certain time frame tells me the quality of follow-up that my investor relations reps are doing. And there's a point of diminishing return. So I'll give you an example. If, let's say, the sweet spot is 12 to 15 touch points, and we've defined what touch points looks like, but the sweet spot is 12 to 15 touch points for a lead. At 20, there's a diminishing return. So it doesn't really matter if I follow up with this guy 20 times or 25 times, like the result doesn't really change. But at the same token, there is an opportunity that we're not even giving ourselves if our average is 7. So if our average touch point is 7 and we know that the sweet spot is actually 12 to 15, and we're just generating more leads, we're actually running the wrong playbook by saying, hey, Danny, how can I generate more leads for less? When the real problem may be, hey, you're not touching those leads enough. You're not inviting them to the webinar. You're not putting new information in front of them. And so it's almost a futile effort for us to just try to generate more leads for you at a lower cost, when really there is a sweet spot here that we're not optimizing for in terms of the number of touch points somebody's going to need. And there's new data too. I'm sure you've seen some of this around touch points versus time, right? Like the amount of, like on the marketing side, it's the number of minutes or hours of consumption that someone is seeing of your content, versus on the sales side, we tend to look at either like talk time or touch points. But yeah, what are your thoughts there when it's like, back to my original question, I guess, is I think it's not bad advice to say, I'm okay with a higher cost per lead if my constraint is I only have one guy making phone calls. Because I would rather, Danny, you do more of the work for me, because it's easier for me to throttle you up and down than it is for me to go hire and train a new investor relations rep.
Yeah, I think you're spot on. So a few notes on it. Number one, I want to agree with you and then layer in a data point.
So everybody be okay with your ad costs going up.
Yeah, right. So first data point I think is yes, volume of IR touch points is correlated to more capital raised. So actually one of the guys that we both know, Joe Guidi, did a presentation on this where he was basically benchmarking like all of these different IR reps, tracking their number of activities or number of touch points, and then correlating that to dollars raised. And it was, no surprise that the top third, right, in terms of most touch points, raised the most money. And they were doing, 50% or 60% more volume. So I think your point's spot on, right? And we see this play out higher up in the funnel. So I think the example that I can give is we've got one group, solo IR rep, no appointment setter. So, a lot of the conversation in the beginning of the year was, hey, we're shifting our capital team. We used to have an appointment setter. The appointment setter left. We don't want to backfill. We think that our closer is good enough, to kind of manage some outbounding plus inbound bookings and do a good job. So what we did is we were running lead form, right, which is kind of like typically your like lower cost, higher volume strategy, in tandem with, direct booking through a landing page. And what we've seen specific for this client is they're willing to tolerate a cost per meeting booked that's about 40%. It depends on the day, 20 to 40% higher. You're paying 20 to 40% more for the meeting that's coming through the landing page. But for them, they're like, well, we're saving that money in not having to pay for an appointment setter. And our closer is saving the headspace of not having to deal with the rejection of dialing leads outbound all day. So for them, they're like, yeah, right. Like in the typical model, sure, we'd love to have, the appointment at $250, per booking. We're happy to pay $350 or $400 because of the incremental savings that we don't have to pay for in staffing. And then just like the overall efficiency of the rep, kind of saving him from that specific outbound dialing activity. So I think that's like one example,
That's a
generally
huge
speaking.
tangible too. Like, how do you
Totally.
measure? I mean, especially for a true sales guy, how do you measure the headspace of your closer?
Yeah, I think it's hard to measure, right? So that's and we like measuring, so I think that's not like a path that I'd try to go down too far. But like for this group, it's like they're taking like a really simple approach to looking at it. It's like we've got monthly capital targets that we have to achieve, and we've got a monthly budget that we have to achieve, or that we have to stay within. And we know that this guy's closing at X rate, and we can tolerate meeting costs up to this number, and we just don't want to burden him with it. Could we maybe be slightly more efficient, from a cost perspective going this direction? Maybe, but do we spread our guy too thin and then thus become dilutive to the conversion rate and then miss the target? So it's interesting. Listen, not every group looks at it that way. And I think that there's other factors at play as well. You made the note of like more leads without the ability to dial them. I mean, we see that all the time, right? The top performing groups that are running kind of the core lead gen model, they're making at least 5 to 7 outbound dials per lead, in an effort to set an appointment. If I'm evaluating spend for a group that's got a substandard lead to meeting rate, we're going to first look at that, number of calls made against contacts that have come into the system. And if you're making 1 to 2, right, it's like, well, you're doing 80% less volume than your peers. Does it make sense that the lead to meeting rate is lower than your peers and thus your costs are higher? And, of course, the answer is yes. I think this kind of dovetails into something that I'm sure we'll touch on, which is like, how do you win in the space today? And the unfortunate reality is like, you've got to be really engaged. Like it's a high effort business to raise capital
Yeah.
from strangers. Yeah.
What's your quick take? Setters or no setters?
I think always setters.
Really?
I really do. Yeah. I mean, we've seen it play out in a lot of different cases. I think like I've got a hot take on how the setters should engage.
Okay.
I think in a perfect world, your setters are US based with iPhones in their pockets, and they're sending blue texts and video messages and audio messages. And they're like genuinely like a really good foot forward kind of first interaction with your brand. I think that there's reason for some concern, right? If you've got an untrained, and listen, they're amazing, amazing VAs. Like you can train Filipino, or I think Nigerian is where some of our clients get reps from, or Brazil or Mexico. You could get amazing setters from those overseas markets at great cost that could be amazingly well trained and have spectacular outcomes. We see it all the time. So I'm in no way dissing that model. What I've seen though in some instances, because like as a marketer, there are occasionally times, right, where I'm going to roll up the sleeves and I want to call the leads myself just to like get a sense of like who are the folks coming in. I'm like, gee, I'm getting a much higher lead to meeting rate than the guys in the Philippines. I wonder why that is. I think it's just like context, right? Like if you can get somebody in-house that can really provide an amazing first touch and differentiate yourself, right, from the strictly business qualification call right out of the gate, yeah, I think you're gonna end up winning. The example that I'll give, I was calling, again, this is not like something that I would normally do. I don't want to like set that expectation. This is like more of like a sick curiosity where like somebody made a bet. They're like, I don't think that you can beat the lead to meeting rate that we're getting with our setters. I'm like, I think I can. So I was like, can I call your leads? Yes, great. You know, like for example, lead comes in and the email address was like at pga.com. So I say to the guy, I'm like, you know, hey Joe, Danny calling from, you know, insert firm name, calling to talk to you about commercial real estate investing, but beforehand, you're not a golf pro, are you? Oh yeah, blah 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 blah, right? And it's like you'll never train that stud, but like you'll never train that into like a highly systematized appointment setting operation, but you can
Right.
train that into, you know, an in-house resource who's kind of sitting, you know, sitting with you and it's getting creative. So I'm bullish on setters. I think that they're really important. And I think that to the extent that you're fortunate enough to staff somebody, you know, US based and kind of have them in office and train them and equip them with an iPhone, you're going to get disproportionately better results. And I think that the way that um, you can analyze that decision is really kind of looking at lead to meeting rates. If we're just using round numbers for an example, say you've got a $50 lead cost and you're converting leads to meetings at a 20% rate, you get a $250 cost per meeting. And then let's say that you're getting a 50% show rate, so $500 cost per show. We're seeing in a lot of cases that US based setters are resulting not only in higher lead to meeting rate, but in a higher show rate, right? So it's like that first interaction is actually carrying weight throughout the pre-book or throughout the pre-meeting process. So it's
Yeah.
like, well, now all of a sudden, if your lead to meeting rate is jumping to 30%, so you've got 30% on a $50 lead, you know, you're at $175 cost per booking, and then your show rate is 80%. So now you're at, call it 265 cost per show. Somebody do the math on that. I don't think I'm perfect.
Right.
But
But
you
you're getting to a net almost half of what you would have been paying.
correct. Exactly right. So it's like, you know, you're saving $240. And if you're going to try to book in, you know, I don't know, 50 meetings a month, all of a sudden it's 10 grand or whatever the number is. And you're like, wait a second, maybe it is worth it to have this guy in my office versus sending that money to Zuckerberg at Facebook. Like that's kind of the calculus to be doing it.
Yeah, interesting. Okay, let me ask you a follow-up to this. Are you more a proponent of setter in terms of a process or in terms of it being a different person? Could you have your closer also be the setter for themselves and still follow a setter closer framework where you're doing a quick touch point to set the appointment, confirm the appointment with themselves versus does it need to be two separate people?
I don't have perfect data on it. I like try to answer questions where I've got data. My gut feel on this, Ian, is I like the separate person. My thought is this.
Protects the headspace too, like we said
That's the
earlier.
first. That's the first thing, right? It's like the appointment setting job is completely unglamorous. You're dealing with lots of rejection, non-accredited leads, and spam leads at the cost of doing business and paid acquisition. So you don't want your reps kind of going off the rails on that front. Like ideally, your reps are only talking to people that they believe every time they get on the phone that they can close. I think there's an intangible there that matters. What I think is more important though than the rep's headspace is actually the dynamic between the lead and the person that they're talking to. So we think about it, lead is talking to setter, right? There's a power dynamic. The lead is more powerful than the setter, right? Ideally, though, when they get to the sales call, there's some level of equality, right, between IR rep and the lead. And then just kind of as a general note, where the GP can jump in and the GP's got a lot of credibility, then you can actually shift the power dynamic where it's like, ooh, wait, you're kind of more big time than me. You've done $50 million in real estate and you're, you know, looking for outside partners and you don't really care if you get my money or not. You're just I think that power dynamic matters. So I think that the closer being the outbound guy is a little bit dilutive to his or her credibility,
Yeah, I get
which
that.
could manifest in conversion rate problems down the line. Do I feel like I've got some anecdotal, kind of like stories or feelings to substantiate that? Yes. Do I have data on it?
Sure, sure. What's what's some low hanging fruit that guys don't take advantage of?
Get active in your own market. Like I think that
You just did this. I think it was I won't say who. I think I'm pretty sure this is somebody that you work with. And I just saw they said a couple of their static ads said quit investing money with like GPs you've never met before.
sounds right.
And
That sounds like us.
it was they named the city. So they said, "Hey, investors in blank, like either book a call or meet me for a cup of coffee."
But
And it was this idea of like tapping into the local market and kind of this idea of like work with what you've got.
yeah,
But
so
tell me
I
more about this.
love it. So glad you brought it up. So again, I always say like success in capital raising is a function of trust. How can you accelerate trust, right, to raise more money? Well, you can accelerate trust by meeting somebody in person, right? If you
Hmm.
shake somebody's hand in person, there's like a human psychological thing that's happening. It's like, oh, I shook this guy's hand in person. Like, I know who he is. I know where he lives. Like, he's less likely to screw me over than the guy that I met on a phone call, maybe a video call, who's been emailing me nonstop, asking me to review documents and sign something and send him 250 grand, right? So I think like implicit in the fact that meeting somebody in person builds trust is something that's important for capital raising. So the story
I
is
got a
that
weird data point on this. So
okay,
this is like a, you know, primitive human psychology built-in DNA hardwiring thing. What they found was when you shake somebody's hand, within like 2 to 3 minutes, you will bring your hand somewhere up near your face because you're trying to catch a whiff. You don't know that you're doing this, but it's a smell thing that you are using that as a way. Like you shook somebody's hand and you are now trying to essentially smell your hand, which tells your brain something about them, if you can trust them, etc. And so there is actual science behind this of if you shake somebody's hand, there's level of trust that gets built.
yeah, I love it. So I think there's two things on the in-person stuff, right? So it's assets in the market that people know, or it's operators in the market. So I'll give you a couple of examples, right? So our first kind of like foray into the geo world of capital raising advertising was actually a couple of years ago. We had a multifamily developer whose raise was kind of stalling, and we ended up pivoting the entire campaign to be as a group in California, pivoting the entire campaign to be like, hey, come for a property tour. We're building something amazing. And the property didn't exist. It was a piece of dirt, but the piece of dirt was close to the beach. And they brought the people to the piece of dirt and then took them out for pizza and beers after. And all of a sudden, check size goes up, conversion rates go up, and and it's a big success. So we're like, ooh, this geo thing is like really, really cool. So if you've got an asset, and we know that like not all of our clients are investing in the markets where they live, but if you are investing in a market where you live, like, run geo campaigns for people to come and see the assets. Cause I think that's the other thing, right? It's like people want to know what they're investing in. And if they're investing 5,000 miles away, it's probably you're going to have a longer sales cycle, right? Than like, oh, I can just drive and go visit this. It's like 5 minutes down the road. I can see it. I know it's real. I know that there's cars parked out there. People live there. So I think that's important. So then the flip of it is like, well, maybe we're not investing in a market where we live, but we can go to that market, or we can go to other markets and be present in markets where there's disproportionate number of people who are of higher net worth. So this is kind of where you're seeing, lots of different groups traveling to markets saying, hey, investors in this, in this city, right?
Are they doing that more on a private invite basis? Because I would imagine the actual workflow here is you're going to collect zip code when you generate the lead. You're going to geo map that to see where the cluster of leads are coming from, some type of filtering, hopefully showing the higher net worth ones. and then you're going to go, you know what? Yeah, we are going to do a investor dinner in Dallas and give out a +1, but we're just going to send it to that email list of people, or like we're going to call those people one-to-one or send them something in the mail or whatever. Or are you saying do a bigger meetup and target that market?
Oh, yeah, a lot of ways to do it, right? You can analyze your existing database and say, where are the people that invest with me or are interested in me? Where are those people located? Go to that market, right? And you can seed those people with free engagement emails. You can send mailers, a lot of different ways to skin that cat. Or like you mentioned, like, which is very common across the customer base, is we are going to be in Phoenix, right? As an example, I'm going to run ads in Phoenix and drum up interest. I'm going to have my IR team qualify those people. And when they've qualified those people appropriately, they're going to give them the, address for the dinner. Tell you a group that a guy that does this really well, and I don't think he would mind, sharing his name, is AJ Osborne, self-storage operator. Like, he dots around the country and pieces together, and he's been doing it forever. Like, he pieces together these dinners, and, at the last second, and he's got a great list and just emails a list. Hey, I'm here. Let's piece together, an investor dinner. And he's out there, and he's, builds a lot of trust with people and creates some great opportunities that way.
Yeah. This actually, okay, because I've seen guys do this, like Pace Morby, for instance, constantly doing meetups and stuff, right? And I think this is something that is a common dynamic with a lot of guys raising capital is they kind of create two offers. There's an education component, and then there's a invest with me component. And I think Cardone probably was one of the best at this early on, and a lot of guys I think have mimicked it since. But he basically said, "Hey, I'll tell you exactly how to do this. Buy a deal of this size, go find the money. Here's how you run it. Here's all the things you're going to run into. Here's how to underwrite it." He would go through all the details of it. He would do webinars on it. He would do free calls on it. He wrote a book about it. He would give the book out for free. And essentially what he has since then admitted is I'm educating people on how to become an active investor, which does two things. Builds authority that I know what the heck I'm doing. But the second thing it does is it tells them how really, 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 really hard it is. And if you're hesitant or not sure if you want to do it, the alternative is you could just give that money to me. And I think some investors don't realize that playbook is what's happening sometimes. And so they start educating, but they like don't know why they're educating. They're just like, well, it seems like every other real estate guy is like teaching real estate, so I'm just going to start teaching real estate. And it's like, what are you doing here? You don't have a separate offer, and you're not creating this alternative spin-off. What have you seen where maybe guys have made some mistakes and like muddying the waters by doing things that aren't helping them actually raise capital?
Yeah, it's a good question. I would say, listen, there are a lot of educator guys that are very successful in capital raising, and they've brilliantly bifurcated the offers, and they've got a very successful info product business and a very successful real estate private equity firm. I think that, like, the safe assumption for the vast majority of the audience is to assume that you're not that guy, which I think is probably blunt, but the reality is like, if you're starting from zero with no audience, it's going to be very hard for that info product or that education business to like really achieve some sort of critical mass without spending tons and tons of money on, ads, or spending tons and tons of money on content, or years and years and years and years, kind of like building that organic audience. So I would tell people to choose, and I would generally tell people to, if they're great real estate operators, do the real estate thing, right? If you're amazing at that, don't try to sell courses. I mean, again, like, I don't mean that as like a slight. Like, we have tons of successful clients that are on both sides of the aisle, who I think add tons of value to the investor ecosystem with their info products. But I think you're spot on. Like, we see a lot of groups that are trying to kind of straddle that education plus capital raising narrative. And then, I think that then the pain point, to your point, I think you mentioned before, it's like check size is a big lever. And then the pain point becomes check size. It's like, well, I think that more sophisticated investors, the guys that can write the $500,000, $1 million check, the family office that's going to come in for $4 or $5 million. I think that there's probably some sort of negative perception that's associated with the info product space, and probably for good reason, right? Like, I think there are a lot of amazing info products that are out there, but I think we can all collectively agree that there are some info products that are out there that maybe aren't so great. And there's probably a stigma and a reputation that's associated with that space that like maybe you don't necessarily want to like attach to your private equity brand. So
Yeah, I mean, the elephant in the room is that it can be associated with a cash grab. And so as a large firm, you don't want to be associated with a cash grab, short-term minded type of group.
totally. I think like, you know, to the extent that you're willing to give educational material away for free, I think that's amazing. I mean, everybody knows Hormozy, I'm sure. I mean, I think I saw at one point the $100 million leads book right behind you, right? Yeah, I mean, he's all about the, you know, give things away for free, and I think that that's precisely what people should do. I think a great example of a group that I've seen giving away an educational product, a guy that I know spent 9 months perfecting this 64-page ebook on how to vet multifamily syndicators. Now, of course, implicit in the content of the ebook was that he was the multifamily syndicator that you should, you know, ultimately move forward with, and I think that's great, right?
Yeah, there's an
Genrevv,
educational component around saying, hey, here's what to look out for. Here's how people do it. Essentially, you're saying, I'm going to teach you how to evaluate me that makes me come out smelling like roses.
yeah, of course, right. And I think like, you know, it's clever and it's effective. And I think that like there's you can still add a ton of value, right, and do that. And I think that everybody involved, the reader of the ebook and the producer of the ebook, can collectively be like, yeah, we know that like I'm trying to sell you on me. I know that I'm like maybe trying to consider you, but like if there's value to be added, there's value to be added. And I think that you should add that value.
Yeah, agreed. It's kind of back to what we said earlier of like, work with what you've got. Don't try to mimic what you see other guys doing. Like if you invest in your own backyard, lean into that. If you put your own money in your deals, talk about that. Like don't try to just replicate what other guys are doing, thinking it's going to work well.
So I've got a client who, and it's, you know, we always love when we've got folks that like happen to live near us, which is great. We can go see him in person. So I got a guy near Boston, and his whole thing is he's like, yeah, I've never bought something further than 30 minutes away from me. The way that he said it, it was so matter of fact, like Danny, what are you talking about? That why would I ever consider investing beyond driving distance, right? How could I possibly do a good job for my investors? How could I possibly manage that asset effectively? And I'm sitting there hearing that, right? And I've written 5 or 6 checks, all of which to my customers, in fact. But I'm sitting there hearing that. And I'm like, this is a guy I think I would want to invest with, right? Because you can kind of like that's a differentiator there where I'm like, ooh, like this is interesting. So, you know, Ian, to your point, I think find what you've got, lean into it. And we can talk about differentiators and kind of how to create that like you know, one of my great copywriting mentors, Bill Schley, calls the kind of the category of one, which is I'm sure borrowed from lots of different places. But yeah, I think that's a good point.
Yeah, I was talking to somebody earlier and we said ultimately what the investor is trying to answer is who are you and what have you done? So it's what makes you unique, how do you stand out, and what's your track record? And I think you have to lead with that. You have to control that narrative and you have to constantly be banging that drum, putting it out in front of people. And then I think, I don't know your take on this, but I think there is something to be said for you're not trying to get everyone to invest with you. Like you can raise a bunch of money from the wrong people and have an absolute cluster on the back end dealing with the wrong type of investors. And I think there's something to be said for saying, I'm just trying to attract people that want to do business with me the way I do business. And I'm not for everybody. And it's not like in an abrasive way, but it's honing in on like, who are your 20% of people? I'm not trying to attract 100% of the market. I just want the 20% that are a good fit for me, where I can get higher conversions. They're easier. I got a better jumping off point. There's something relatable, whatever, but you got to lead with your uniqueness and what makes you different, what makes you you, so that they know what the heck it is that they're signing up for. And you're not having to go through that same like rapport building, digging backgrounds that everybody else is doing.
Yep, I love it, and I think that I think one of the big mistakes that we see is you said what makes you you, right? A lot of people are going to think about that in the context of their firm. So what makes me me as a value add multifamily syndicator in the Sun Belt? It's gonna be tough, right? There's a lot of them, so it's the vertical integration, it's, our strict sensitivity analysis and diligence, it's the, off-market broker relationships.
It's our team. Everybody, it's
It's our
always the
team.
thing out there. It's our team. Our team's the best. I
Yeah,
always like to challenge, like, prove it. Like, we're coming in, we're comparing everybody's teams, and prove it. How do we tell your team's the best? Because everybody says that.
so I would urge people to, like, Ian, when you say what makes you you, don't look at it from the business perspective. Forget the vertical integration, forget the team. My favorite example of, doing a video sales letter with one of the clients, and um, he opens it up and he's like, Danny, I'm one of 16, Midwestern boy, grew up in a big family, hard work and trust. And I was just like, that's the difference, right? Like, people aren't remembering the vertical integration, the broker relationships. It's like, no, you bet I remember the guy who said he's one of 16, grew up in the Midwest. You'll never forget it, right? So it's like, I try to ask people, it's like, don't don't hide behind this veil of buzzwords and listen, I agree with you, the track record's critical, but I think that what we're also seeing in the market, particularly among sophisticated investors, is like, track record, dated 18 to 23 is probably a lot different than track record in 24 and 25 in a much different interest rate environment. So I think that, like, deliver your track record with the utmost transparency. I think that's incumbent upon every operator to do. But I think, like, the what makes you you, it's like, it might not be the 13 years at Marcus and Millichap. I think it's relevant. I certainly think it's relevant. And, I was on a call today where a guy was telling me about his background at Marcus and Millichap, but what really shined through about that guy was there's just so much authenticity in the way that he spoke. And he's like, I just don't care what people think anymore. Like, all I want to do is create the right outcome for the investor. And, he's kind of got a little rough around the edges with his language, right? A lot of cursing. And if that's you, like, be you, right? And I kind of, same thing as the Midwestern guy, one of 16, the same thing as the guy who was kind of cursing all the other, his peers in the industry, I think, in some way. I'm not going to forget that guy.
Yeah.
Immediate thing. It's like, so what can you do to be unforgettable?
I love that. I've got a guy he's actually up near you. He's up in New Hampshire, Mike Ketchin. He's a fantastic operator. And we were having this conversation the other day where I was telling him how I view it. And I think what really comes across that maybe he's not putting words to yet is his background as he was a school teacher, then a school administrator, and he basically orchestrated this massive turnaround in this high school. It was like underperforming high school, and as an administrator, they turned that school around. And what he does in multifamily is he finds value add C-class properties and he turns them around. And so I love when you can find those common threads and you can say, man, Mike's got the ability to identify potential in things. And he's a little New England. He's a little brash at times, right? I tease once in a while, I say, hey, your Boston is showing. But I think it's because his passion comes from the fact that he can see potential in something and the frustration of not being able to bring it into reality yet. And so he moves so fast with so much clarity. And you could see this commonality of where he's done this his whole life. So it didn't matter whether he was in the school system as an administrator or he's operating as a multifamily operator. He's doing the same thing. He's identifying potential and turning it into a reality. And so to me, that makes it great where you can see, oh, this guy has done this his whole life. Like, this is just part of who he is and how he operates. And so I think that's a great point, is like, look at it not through the business lens, but look at it through like the personality lens of, man, this is just kind of who I am, how I'm different, how I'm wired. I think
Yep.
that's perfect. Okay, a couple more questions for you. I want to ask you, because again, you guys do way more than just paid media. You're very much like end to end. And so give me kind of a big picture, what all the heck it is that you guys do at Genrevv.
Yeah, thanks for asking. So I think, like, core service is really, net new investor lead gen. So we've tapped out our friends and family. We need new sources of capital. how are we going to get new sources of capital? Like we deploy the majority of the spend on Facebook, generate those leads, run those leads into your CRM, put them through, marketing automation, emails, text, etc. Send them to landing pages with video sales letters on them, and then, instruct you to have an appointment setter to dial them while they're booking inbound from landing pages or emails and texts. And you take it the rest of the way from the point of meeting booked, right? That's kind of the core service. So I think like acquisition is one piece of it. Investor acquisition is one piece of it. I think investor engagement is kind of the other piece, which is like we do a lot of marketing for webinars. So we'll write a lot of the content to drive investors, existing investors, new investors, whoever's in your database to show up to webinars. We do newsletters, right? So keeping your list warm, sending out value-added content, current events, we'll do the research, write the copy, etc. So I'd say those are kind of like the big three things. And then our play on the tech side is, we've got the partnership with Windfall, right? The data enrichment component, I think, is super valuable. That kind of dovetails in with the acquisition component. And then we've got like a little tech product we call CapSync, which is kind of a tool that keeps your investor management platform, so like your InvestNext, your Appfolio, Agora, etc., keeps that in tandem and in perfect alignment with your CRM, like HubSpot. So I think one of the big problems in the industry is like, InvestNext says that we've raised 72 million, but HubSpot says we've raised 48 million. Beyond me, I mean, it's a huge gap, right? It's like we want to put together targeted re-engagement campaigns, or we want to dial people, but the platform from which everybody is doing all of the investor engagement is not current or accurate with the amount of dollars or what deals they've invested in. So we've built a bridge to create that kind of one-to-one piece. So yeah, I really look at us as like a kind of investor acquisition engine that's going to help you engage and nurture those leads. And then, over the long term, I kind of look at it as like a retention marketing play as well, where it's like we want to help drive reinvestment rate, because it's really my belief that, if somebody works with us long enough, it's my hope that at some point dollars exceeds deals and you turn off the ad spend, right? And we actually saw that with one customer in 24. He's like, hey man, like I've got more dollars than I've got deals. I got to shut you off. And like, again, as an agency guy that runs a business on recurring revenue, we're like, geez, that's no good. But it's cool, right? Like the whole point is that over the long haul, as you build a big enough investor base and you deliver great deals and great outcomes to those people, they should reinvest at a high rate, tell their friends, create new network effects, right? Like all those referrals that you were getting from your friends and family, you should be getting new referrals from those cold leads that come in that invest with you, and create a new flywheel such that you don't need the ad ecosystem running 24/7.
Sure.
Most of our customers, though, are pretty ambitious, right? And they've got more deals than they've got dollars, which is good for business. But that's kind of what we do in a nutshell.
Well, I feel like one piece I want to hit on that you didn't mention is the strategy side of things, because you have such massive insight into the whole ecosystem and what's happening because of the amount of clients that you operate within this one niche. You can see, without necessarily disclosing who's doing what, you can see trends emerging and you can see what's happening across everybody. To, I think, it's a huge component of the value that I've at least witnessed in our conversations and collaborating with a few clients, is the strategy component, where it's like, if I've got a question, I'm going, hey, Danny, what's going on? Like, are you seeing this? Because here's what I'm seeing. And I know that you are almost going to be the like more factual side of things, because you do have this back end insight, but across a larger quantity of a massive amount of ad spend.
Yep, for sure. Yeah, I appreciate you saying that. I think that is one of the big value components, is like, if you're running the marketing ops for capital raising in isolation, you're probably missing context, right? It's like, well, lead cost is this, my credit rate is this, my spam rate is that, my show up rate is this. Where does that actually fit in relative to the industry? And when we see, spikes or declines or improvements or degradations, like, are we seeing that at the ecosystem level, or is it an isolated example? So like perfect example I think we spoke about before the call is like in the first few days in July, there was a huge spike in spam on Facebook, right? And like we identified that as like a ecosystem wide, issue. And then you're able to deploy lots of different like kind of technical media buying tweaks to like very quickly see what works and then deploy the whole solution across the customer base.
But it also keeps the investor who's operating in a silo from spinning their wheels and going, what the heck's going on? I need to try this, try this, try this. And they start pulling levers they don't need to be touching.
Correct. Yeah. And I think, in a lot of cases, like
It's peace of mind, right? It mitigates some of the panic.
totally. And I think like you said it, like saving time, right? It's like something's not working, right? So it's like, okay, if something's not working, we need to do something entirely new, is like generally the school of thought. It's like, this is failing, do something different, which like makes sense, right? Definition of insanity is like doing the same thing over and over again, expecting different results. But oftentimes it's like, it's not that the whole thing is broken, it's that like one little piece is broken. And like, as you know, I think spending a lot of time in the marketing world is like, things break all the time. And it's not that things are necessarily breaking, it's that things are changing. And then like, part of the reason marketers exist is to respond to change, both from like a technical analytics perspective. It's like the actual levers and the buttons that you're pushing in Facebook, on the media buying side, and the buttons that you're pushing in HubSpot, but then also from like a messaging perspective, right? Because like I think I mentioned before the call, we saw in April as we were kind of at like peak tariff uncertainty, are the trade deals going to get done? Is every, the global 10 or 20%, tariff going into effect? Is China going to have 130% tariffs? So the stock market had, really gone down at that point. I don't know what it was off 10, 15%. And we had seen lead costs, and we've seen this over the course of time. We see, lead costs and outcomes actually correlate to the S&P in a lot of ways. So there's no amount of button pushing in HubSpot or in Facebook that's going to overcome material degradation and sentiment. But what can overcome that is material change in message.
So material change in messaging, what does that look like exactly? You're updating copy, headlines.
Test new creative. Yeah, I mean, so like you're constantly testing new creative as a marketer, and I think like different messaging is going to resonate at different times. So like for example, just very very rudimentary, it's like if your 401k is off 20% because of tariff uncertainty, you might be more interested in that moment in something that's not correlated with the stock market. Generally speaking, right, these kind of small private equity guys, or just like real estate private equity guys in general, tend to position themselves as like, hey, like we're not typically correlated to the market. So you're gonna go out with that messaging, right? Like hit people with what they're thinking about in that moment and, try to take advantage of that. Now, like, when the S&P is roaring, it's a more difficult sell, right? I think that
Sure. There's other opportunities. You've got supplements in the market.
yeah, totally right. So it's like, so what are the more like specific points that you go after at that point? It's like, well, we see a lot of times that people are entering the private markets for cash flow. I think that generally speaking, sure, there are some dividend plays, in the public markets that, that you can do, right? But like the whole cash flow narrative in the private markets has kind of been like a winning angle for years. So that's kind of something that you go after, right? When times are good. So you're constantly tweaking messaging to align with what's happening in the world at the given time.
Yeah, dude, super good. Last question for you. How does somebody know that they're ready to start running ads? How do they know that they should be reaching out to you? And is it still worth it in today's market when cost of capital for a lot of groups is starting to go up? If a guy's just getting started, is maybe just expectations wise, should he know it's going to be maybe more of an upfront lift? Does it still work? And how do they know that it is the right next step for them?
Sure. Yeah. So I mean, I think like a few things there. If you plan to be in the space for a long time, um, right? Like it's probably easier for me to say like who's not a great fit, right? Like if you're raising money for one deal, it's like, hey, I've got this deal under contract. I need funds in 45 days to close. I want to spin up Facebook ads. It's like, oh, that's not going to be a great fit, right? When the average sales cycle for cold traffic is 60 to 75 days. So we wouldn't take somebody on like that, but somebody that plans to do, a few deals a year, plans to be in the space for a long time. They've kind of tapped out their existing network of friends and family. Their existing investor base is tapped. So they're kind of at a spot where they're looking to explore kind of broadening their investor base, I think that's, probably a good time to reach out to answer the question directly of like, does it still work? Decidedly, yes. Right? We've got a lot of clients that are still seeing the costs of capital of the glory days of 21 and 22, that are really experiencing great outcomes on the platform. I'd be remiss to not mention that like the competition is greater, right? There's definitely more advertisers in the space. There's more groups that are kind of on that Facebook channel, but there's more groups on every channel, right? So I think that at the end of the day, like if you're looking for money, we really haven't found a more efficient channel um, with predictability and scalability than with Meta. We've spent money on LinkedIn, we've spent money on Google. There are other strategies for sure. Like I don't, and happy to speak to one of them, right? Like I think that, LinkedIn Sales Navigator, right? Going after people from your university, there's no ad spend cost for that. So I think, you've kind of got to like look at your organization and see like, hey, what type of budget do we have to deploy on, investor acquisition? What are we comfortable with? Again, there are ways to play ball without spending money on ads. It's not for everybody. We certainly don't position ourselves as like a single source solution for capital raising. I really say like Genrevv is a point solution on acquisition for a specific channel, which is that kind of like Facebook paid ads channel. And then we believe our middle of funnel marketing is really meant to benefit your entire capital, operation. So, a lot of like the typical customer for us is, hey, we're running spend on Facebook. We're doing in-person events and networking events and things like that. Maybe we're sponsoring a couple of conferences. Maybe we drop an ad in a newsletter here or there. Genrev's owning the paid ads channel. Genrev's running my webinars. They're running my newsletters. They're using Windfall to data enrich all of my leads, past, present, and future, independent of lead source. And they've got the kind of cap sync tech tool to make sure that my marketing automation and sales tool, HubSpot, Go High Level, Active Campaign, is singing from the same sheet of music as InvestNext, Appfolio, Agora. So hopefully that answers the question.
Yeah, fantastic. Where can people reach out to you if they're raising their hand right now and they're like, that's me. That's the point I'm at. I've tapped out my warm network, my existing investor base. I don't want to lose momentum. What's the best way to engage with you and your team?
Yeah, I'd say shoot me an email, Danny, DANNY, at genrevv.com, GENRE, two V's always gets folks.
Double V. I can never remember if it's double N or double V.
I hear that a lot. Yeah, double V. You can go to our website, genrevv.com, find me on LinkedIn, though I feel terrible. I went on LinkedIn for the first time in like 45 days and had a few people that had reached out, hey, would love to learn more. So yeah, LinkedIn's probably not the place to reach me. Email would be best.
Awesome. We'll make sure to link your email down there, spelled correctly, as well as the website, LinkedIn, just in case. But dude, thank you so much for being on. I think we got to do a part 2 of this because there's a ton we didn't even get to touch on.
Yeah, for sure. Happy to.
But I find these conversations so refreshing because you're able to speak to this at a high level as well as the tactics, and you just have a tremendous amount of insight into what's going on in the industry for everybody and the economics behind it. And so invaluable, man. Appreciate it a ton.
Thanks for having me. Appreciate it.
Yeah, thanks, dude.
Holy cow, I did not think that was going to go that long, but Danny had so much good stuff to say. He's got so much insight into like really tactical stuff because when you work with him and his team, like you actually get Danny. Like he's in the weeds doing the stuff. But he's got a full team behind him because they help you from A to Z. So if you feel like you are at the point where you've maybe tapped out your warm network and you maybe need to start reaching out to a colder audience, running ads to bring in additional dollars, then be sure to reach out to Danny and his team at Genrevv. They are incredible strategists in addition to being not only just your paid media buyers, your campaign funnel managers, helping you from A to Z. Incredible strategists. I always have great conversations with Danny, and I think so unique in terms of the pulse he has on the market from big picture economics that are happening all the way down to the nuts and bolts of what's working on Facebook, what's not working. So be sure to reach out to his team if you feel like you need any help running ads. Danny and his team at Genrevv can absolutely help you.